Okay, here we are, another episode of Flipping Houses for Rookies. And I have Ryan Morrissey with me today. We're going to get into that in a couple minutes, but we're on episode number 265. The name of the podcast is Expert Ryan Morrissey Reveals How to Get IRA and Retirement Loans to Do Deals Easily. Whoa, that's a big, tall order for you, Ryan.
Yes. Hidden secret.
Yeah, hidden secrets. All right, good. So here's today's description. Most real estate focused people know they need to find the bargains. That's, like find the pretty house. The ugly house in the pretty neighborhood, that whole thing, right?
Sure.
But not knowing where to get the funds to do these deals keeps a lot of people out of the business and costs them, quite honestly, their financial freedom. So today, we plan to change your viewpoint on where the best source of money you'll ever find is all around you. It's like you'd be surprised how many people have these retirement funds when you start talking to them, right? So we're going to go over that in a few minutes. You just need to put your funding goggles on so you can see it and then go do it, right? Just go find these people. So like I said, expert Ryan Morrissey is going to show us how there is an inexhaustible supply of real estate funds without using your credit, bank committees, and how you can get this kind of money in days if you know how to do it. Now, he's not going to go over the details on how to do it in days. I'm going to help him with that. But once you find the right people in the right places, you can get this type of funds in days, right? Plus, you won't need to beg for it. That's the best part of it. Once you do what we're going to talk about, these people will be begging you instead of you begging them. Usually, that's what happens to me. So while Ron talks about this, how to use these IRAs and retirement funds for your deals, you'll start to see how conventional wisdom is almost wrong about all this. You know what I mean? and unless you're on the collection side of the coin, you'll realize that maybe, the conventional wisdom is not the way I want to go, right? So if you're dead broke, too squeamish to use your hard-earned loot or for acquiring real estate, then this podcast is perfect for you. So let's just kick back, listen carefully and see if you can pick up some tips. All right, so we've been kind of moving things around here. Usually it's been, for a lot of podcasts, it's been Pete, the rookie, and myself that are doing it. Pete's off on a sabbatical, so I've had some different guest speakers and some different people. First of all, I want you to know that if you are interested in being on this podcast as a student, I have a contest that's going on right now. So if you go to flippinghousesforrookies.com/contest, you can see what it's like to get onto the podcast. There's a contest there, which I give away a 14-day, really extensive email course on how to get a deal in the next 14 days. It's one of my better pieces of work. I don't even know. It just kind of happened, and I like it. So also, Ryan is going to, as soon as I get done introducing him and all that stuff here, I would imagine that you may want to talk to him. He's a pretty sharp guy, especially in the financial world. And so in the description, I put his link to his website. So wherever you're watching us or wherever you're listening to us, just go in the description and there's a link there. He's going to give us his name and if he wants phone number and all that stuff too. But at this particular point, just go in the description. You can find his website, all the stuff that he does. And realize that if you're subscribed to our channel when we go live like we are today, because we've been kind of moving the times around when I go live, you can go watch us on Facebook or YouTube. And I have a big screen in front of me. So if you have questions while we're chatting, you can send them in either through Facebook, Flipping Houses for Rookies, or on YouTube, Flipping Houses for Rookies. Just go on there and you can find us when we're recording. Usually we do it Thursday mornings at 9:30 Eastern Standard Time, but I've been moving that around, trying to test some new time, see if there's a better time to do that. So that's why it's been like that. But mostly all the episodes are there, or you just go to flippinghousesforrookies.com. Okay, so first of all, get that out of the way so the geeks get off my back, right?
A long intro, Bill.
Yeah, it's like, oh my God. We do it every week too. So welcome, Ryan. Thanks for taking the time out of your busy schedule, because I know that you've got a pretty busy schedule to shed some of this light on this very confusing topic for a lot of people. I know that a lot of real estate guys, such as myself, especially through my training, and it's not changed in 20 years, will go to these real estate seminars, or they'll listen to these gurus, and they'll make these passing comments. You know, the two things that irritate me the most about my business is they'll talk about subject to deals and blah, 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 make it sound so easy, and they don't have the right facts. And the other thing is, you know, investing in your IRA and retirement funds. You know,
Sure.
they pass these two comments so they look like they're like some superstar up on stage, but they don't. They just like leave the attendance, like the attendees, just hanging. So so I want to get into that, but before we dig into that, I just wanted to set the pace for letting our listeners know the best source of money you'll ever find for deals is from people that are just like you, the listener, who like just a higher rate of return on their savings or their bank account. So you're not looking for like this multimillionaire that has, you know, a 10,000 square foot house on the water, although that's good, but you're probably going to find your next door neighbor can help you, or the guy across the street, or your family member, or your uncle, your cousin, something like that. That's what you're going to find, right? And these private lenders fit these descriptions that we're going to talk about. And once you see that description and you see what we're going to talk about, they're like everywhere. Okay. So just to be clear, before we kick off Ryan here, because I feel like I'm making him wait forever, there are only 4 types of lenders in real estate transactions. So I want to just touch upon that real quick. There's only 4 types of lenders on real estate transactions. And those are obviously the bank, and the bank wants you to think that they're the only one. All right, that's just their motif. So they have all these myths going around about what you can and can't do, which are most of the time myths. The second one is a hard money lender, which these days, I think, Ryan, you know this, a hard money lender is kind of the banker in disguise. You know, they're not
Yeah,
like
they charge a lot
be.
usually. So
Yeah, they used to have their own money, but now they
yeah,
use credit lines and all that kind of stuff. So, and they just get more fees. So 2 is the hard money lender. 3 is the private money guy, which is what we're going to talk about today, which is where I've gotten a majority of my money for the last 15 years is private money, and how we're going to talk about it today. And then number 4 is the buyer's money. So the 4 places to get money is the bank, hard money, private money, and buyer's dough, right? So when your buyer comes and goes to get the mortgage. So like I said, today's Ryan's going to focus on how to take these people that you know that are probably relatives or friends or family or something, and you actually turn them into a private lender. And the way we do that is with retirement funds. So with all that said, blah, 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 you know, like I go on forever here. So Ryan, my first question to you is, let's start off with how our listeners can use, like, just some detail on how can you use an IRA, you know,
sure.
to fund your real estate transactions.
Yeah, thanks for having me, Bill. And
Yeah.
I'm Ryan Morrissey. I'm a family financial planner located in North Haven. I specialize in retirement planning and investing. My company's Morrissey Wealth Management. I've been doing this for 20 years. And normally, and even for me, when I first started in the business, I started with a well-known Wall Street firm, and I never heard anything about how you could invest your IRA or 401k in real estate, right? Everybody thinks my retirement savings can be invested in mutual funds, stocks, bonds, more recently ETFs, right? But you actually have the ability to invest these funds in what's known as a self-directed IRA, where you could invest in real estate, either real estate that you own, or you could actually use the funds to lend to other people, right? You were talking about getting into the private investor. Essentially, you could become your own hard money lender, right? You can use your own money to lend that out for deals. But there are some stipulations around that. And what the IRS has laid out is they'll allow you to do this, but there's a couple things that they have. And one is that you can't buy a property that you're going to live in, right? So unfortunately, you can't buy your vacation home with your IRA.
Come on, you're taking all the fun out of this.
They're not going to let you do that. You can't have any interest in the property. So you also can't lend to what's known as a disqualified person. And this is somebody who, obviously this is yourself. someone who's a beneficiary of your retirement account, also who's your fiduciary, someone who's managing your funds, and members of your family, your spouse, your children, anyone in your lineal descent or any spouse's lineal descent. Now that does eliminate, right? You were talking about family.
Yeah,
go back.
Go back what you were saying about interest in the property, because they kind of go together, don't they? The interest in the familial tie.
Well, yeah, it can't be a property that you're going to benefit from. So it can't be a rental property. Let's say that maybe it's a multifamily and you live in one of the units. That won't work.
I see.
It couldn't be a commercial building that you're going to occupy maybe part of the space for your business.
But if you flip it and make 20 grand, is that considered a benefit or no?
No, that is not,
Okay,
because
good.
you're not actually benefiting in the sense that you're living in it or using the property. So that's what they refer to. So it can be used to flip properties. So let's just say, you and a friend are investing in real estate and you're looking for money for deals. Well, you each could maybe lend to each other as long as you're not related, right?
Yeah.
And that's a way that you could get access to the money, and funding is by using a friend to lend to you and you lend to them, and maybe you don't charge each other interest and you just allow the profits to go back into the account, right? Because that's one of the other things, is that anytime you buy real estate, if you're going to rehab the property, you also, every dollar that goes into the rehab has to come from the IRA, if the IRA is the sole owner of the property.
So you can't mingle funds.
You can mingle funds. So let's say you're buying a $300,000 property and you have $100,000 in your retirement account and $200,000 in cash. Well, You could do that. You could partially buy it with your IRA and partially with cash, but the rehab itself, I believe the rehab, whatever that costs, the proportion that relates to the IRA would have to come from the IRA.
I see.
And then when you sell the property, whatever the profit is, the portion that relates to the IRA would have to go back into the IRA to maintain.
So in the particular case that you're talking about, if it's a $300,000 property, you're putting up $200,000 and the IRA is putting up $100,000. That means the IRA is a third owner of the property. So a third of the profits would have to go back into the IRA, but 2/3 can come to you.
That's right. Yep.
I didn't know that. Okay.
Yeah.
Cool.
Yeah.
It's good to know.
Yeah. And, when you're doing this, there's specific steps that you have to use. You have to use a self-directed custodian who will allow you to do this. And this isn't going to be your more well-known, Fidelity, Vanguard, those are awesome companies that I recommend to my clients, because most of the money that I'm dealing with for my clients is not real estate money.
Right.
It's money in stocks, bonds, mutual funds. But there are some clients that do have interest in that. And that's where one of these self-directed custodians comes into play. And if you've ever looked at the titling, if you own this property 100% in your IRA name, then it would be owned by, the trust company, whatever that trust company is, for your benefit. And, it's not, your name is not on the deed solely. It has to be owned by the IRA or a retirement plan to make sure it's done properly.
Yeah, so equity trust is the big gorilla in the there's others, but equity trust is one of them. There's self-directed IRA. And just to kind of go back and clear up, just in case somebody doesn't know, a custodian is the person that's the manager of the fund. That's the
holder, really.
Yeah. Right.
Yeah.
So they're the ones that are going to make the decisions and do all the paperwork and help you with all that kind of stuff. So that's what you're looking for, is a guy that's qualified to use the retirement funds legally and professionally, so you don't get in trouble with the IRS. That's basically what that guy's doing.
That's right. They're making sure you don't run afoul. So if you don't know this rule and your name is Jones and you submit a deal lending it to Steve Jones, they might say, well, who is Steve Jones? Well, he's my friend or something. Well, they might ask to see proof, because they don't want to screw this up. Because let's say you don't realize that and you lend money to your son, and the minute you do that, now your IRA becomes no longer an IRA. Right. On January 1st of the year that you make one of these non-qualifying transactions, the whole IRA is now taxable. So that really defeats the purpose. The purpose of having an IRA is to, normally it's a money that's going in pre-tax, you get a deduction, and then it grows tax deferred. You don't want to have it all be taxable to you.
Right. So we're going to touch on that a little while later on taxable and non-taxable.
Sure.
And just to show my bad humor, you're not talking about somebody that's jonesing, right? They're jonesing to do a deal. You're talking about their real name.
They could be, but maybe both.
Yeah, there's a lot of those around. Anyways, so I also want to be clear here because, some people just can't seem to get away from trying to figure out an angle. So this doesn't mean that you can lend to your LLC and the IRS is not going to know that. And
yes, no, you're right.
If you're connected to the money, just do it the right way.
Yes, I mean the same thing like equity trusts, because I have experience with them. I've had clients lend to LLCs and they want to see the LLC documents, right? Because they don't, they're here to protect you and themselves. They don't want to find out, the IRS doesn't want to find out, oh, equity trust is allowing people to do all these deals that are not really legitimate. So yes.
So going back to your intro, you said that you were in North Haven. Ryan is in Connecticut with me, so he has the Connecticut law in mind. For sure in Connecticut, I know it's many other states, but you can just go on a website and see who owns an LLC. I mean,
yeah,
it's not that difficult,
I think it's the Concord website, right? It's Concord.gov, something like that. Yes.
So they know. Come on, you're not going to tip the government.
No, they don't.
I mean? They're professionals.
You don't want to get in that business. It's not worth it. There's many other ways to get the money legitimately than to try to use your own account to do that.
Right.
Yeah.
Right. So just because I just want to kind of really make sure we kind of dumb this down a whole lot, could you tell us what IRA stands for? Do you know?
It stands for Individual Retirement Account.
Okay, good. And what you were saying before is it's a deferred tax account. So, that just means that when your tax income is high while you're working, you can put it in this account, and then later on when you take it out, hopefully you have a lesser of a tax ramification.
Yeah, that's the belief, right? We're talking about a traditional IRA.
Yeah.
It's sometimes called a rollover IRA. It's really the same thing. It's pre-tax money. And if you don't have access, I might as well just talk about the rules of, if you're thinking about investing in one of these. So it works in two ways. If you work for a company that has access to a retirement plan, even if you don't participate, if they just offer it, then there's adjusted gross income limits that determine if you can make a contribution and deduct it. So, I have this on my notes here because I don't remember all these numbers. But if you're a single filer and your adjusted gross income is under $66,000, then you could make a contribution. If you're a joint filer and your adjusted gross income is under $105,000, then you can make the full contribution. And the contribution for this year is $6,000 that you could put into one of these accounts, fully deduct that on your taxes per person. So if you're married, each spouse could do it. And then if you're over 50, there's $1,000 catch up, moving it up to $7,000.
So that means if you made $66,000, you're only going to pay taxes on $60,000.
That's right.
Yeah.
Yep.
Okay, so you're taking $6,000 worth of taxable money off your income, putting it in the IRA, and then the point is that the taxes get collected when you take the money out of the IRA, which is presumably when you're retired and have less income.
That's right. That's the whole belief, right? Either pay taxes now or pay them later. Probably for most working people, you're probably at least in the 22% tax bracket. And when you retire, your income's less. You're probably going to, depending on what your income is, you might be in the 22% or maybe even the 12% federal tax bracket. So that's the belief. If you can save 10% in taxes, why not do it?
Right.
And that go ahead.
Sorry to interrupt. So, which is the reason why, and the reason why I'm bringing all this up is because you understanding this, you now realize that why they're so strict about mingling funds and what you're using them for and taking them out, because they know that they gave you like this leash, this rope. They're like letting you, and they just want to make sure that they're going to get their money, right? So when you use the money wrong or do something wrong, they want their tax money. They gave you this benefit, and they just want to make sure you're not sneaking around in the corners of the room somewhere in the dark, getting one over on them. You know what I mean? That's why.
I mean, yeah, there's crazy things you could do, right? Let's say, because the other thing that I didn't mention is that you can't buy a property. You can't have your IRA buy a property that you already own. So
Right.
let's say you own a rental property and you're thinking, well, I could put this in my IRA and then I'm not going to pay the taxes. And you could, but you can't do that with one you own, because let's say you determined the value was really low and you said, well, this is really worth 300,000, but I'm going to sell it to my IRA for 50,000.
Right.
Then all of a sudden, now you then sell it in a year for 300,000, and your IRA that investment just went up, 6 times in value.
Exactly.
That's why that you can't. One of the reasons why.
And just to, like I said, really make it simple. I mean, all these things, your multifamily house and the IRA are all going to be on the same tax return. So when you say you have a benefit in it, it's like, there's your benefit. It's like, because they're all going to be on the same tax return. So that's how I look at it. Is this IRA going to show up somewhere else on my tax return? Which means I have benefit in it. You know what I mean? That's how I look at it. You know what I mean?
Yeah.
So
I mean, one
other
other thing on a tax standpoint is that I point out to a lot of clients is that Connecticut obviously is one of the highest tax states in the country. I think we're, of the worst states to live in for taxes, we're like number 48.
Yeah.
There's a lot of other states.
Gee, thanks for reminding me.
So reminding us, Bill, of why we're here. There's a lot of other states you can retire into that have no state income tax. Yeah. So one benefit also too is that if you are putting money into a retirement account on a pre-tax basis, you're not paying federal income tax or Connecticut income tax. And then when you retire, if you're no longer in Connecticut, maybe in one of these tax-free states, then you avoid that tax altogether.
Like Florida.
Yeah. Florida's the most popular one because of the nice climate, but the best state actually to live in from a tax standpoint is Wyoming.
Really?
Yeah.
Oh, don't tell my wife that. She'll want to live there.
Probably some cold winters there, though, Bill. If you don't like Connecticut, you're not going to like it in Wyoming.
I'm not going there. But she's got this whole thing about the Florida taxes. She's constantly lecturing me on that.
Yeah.
So, little does she know that because all my properties are in Connecticut, it don't matter where I live, I'm paying Connecticut tax. So
yes, that's true. Yeah. Yeah.
So my magic is just to make a shitload more money, and I don't have to worry about it. They just get the percentage. So there you go. All right, good. So I think that's cool. I have no questions so far, so that's good. That means you're doing a great job explaining all this. So now let's dip into the 401k section, or the retirement money, because we're talking about IRAs, which is just one type of retirement, right?
That's right.
So this is your specialty, is the retirement fund, right? Dealing with retirement funds and all that kind of stuff, right?
Yeah, sure. So obviously the IRA, the individual retirement account, is one option. For most people, the primary savings vehicle has become the 401k. And that name is based on the tax code the IRS actually created that then created the 401k. In the early 80s, I forget what year, the 401k was created. And most companies have moved to 401k plans because they predominantly had pension plans where they were then liable to put in so much money for employees' pensions, and they didn't know how much they'd have to put in. So then they figured out they can move to 401k where they only have to put in a match of 3 or 4%, and that's all they're on the hook for. But the benefit,
they're not holding the money anymore. So 20 years from now, they don't have to worry about how many people they have to pay. I mean, it's a whole thing for them, right?
Yeah. I mean, because with a pension, if you know that, okay, I have to pay someone $2,000 a month when they turn 65, you know that. But what you don't know is how well your investments are going to perform between now and when they reach 65. Exactly. So that might mean you might have to put in more money than you thought initially. And companies don't ever like that. Yeah. But the benefit of this is that now you're in control of your own money because you're putting in your own money, and then the company presumably is making a match, because most companies have to put in a minimum match to get the benefit for every one of the 401k. It's called a safe harbor provision. Yep. And that's why these companies put in the money. And some of them might be doing it out of the goodness of their heart, but most of them are doing it because the IRS makes them do it.
The IRS gone, right?
The IRS says this is what you have to do. But so the limit, most people probably know this, but the limit is $19,500 that you can put into your 401k per person. And that's for this year. It gets adjusted per year.
Per person per year.
Per person per year. And it gets adjusted every few years. And then if you're over 50, there's also a catch-up contribution of $6,500 for this year, making your total contribution for this year $26,000.
It's a big number.
It's a lot. So the tricky part, however, is that with your 401k, you really can't access that money as far as moving it to a self-directed IRA or, self-directed 401k until you leave the company you're working for. So you either have to have left the company, either been laid off or retired, or a lot of companies allow you at age 59 and a half to roll over the portion of your contributions into an IRA. So that's one way that if you're thinking about doing this and you're saying to yourself, well, I don't have an IRA, I don't qualify because my adjusted gross income is too high from those numbers I discussed earlier. How do I get my money into where I can invest in this type of real estate? Well, you'd have to either have left that company, an old 401k, or have reached age 59 and a half, and the company allows you to then do this in-service rollover is what they call it.
Yep. Yeah, I've not had as much luck with the 401ks because the 401ks I have found are very company specific with their rules. You know what I mean? Like the organizations really have a lot to say on what they can and can't do. And I'm sure that's because of all the tax assistance.
It's IRS, yeah.
And stuff that we don't see. So, all right. So,
but there is one other thing I should say, though. For any of your listeners that are self-employed, they can set up their own 401k, and they can choose to set that up wherever they'd like. So if they were interested in doing this type of real estate investing, they could use a company like Equity Trust. I've also used another one called Pensco. I'm sure there's more out there, but these are the two that I've had experience with. You can set up your 401k there. You can make your contributions directly to one of those companies, that $19,500 or the $6,500 catch up. And then to further complicate things, you also can add a profit sharing plan onto the back end of these 401k plans, which then allows you to put an additional 20% of your compensation into the 401k. And we're all talking about pre-tax money. So now let's just assume you made $100,000. The math wouldn't work out exactly like this, but we'll just say it's 20% because you have to deduct a few of the things first. But that's another $20,000 that you could put in, bringing your contribution up to $46,000. So that's a way to really supercharge your retirement and also significantly lower your tax bill at the end of the year. And you're putting a lot of money in there that you could use to invest however you'd like.
That's huge. What you just said was huge. You just talked about cutting somebody's taxes in half.
Yeah.
That's a big number,
Yeah.
All right, good. So that's all cool. And of course, if there's any questions with this stuff, why don't you just rattle off some contact information now? We'll do it at the end of the show too, but just so
sure. So my name is Morrissey, MORRISSEY, and my website is morrisseywealthmanagement.com. I also have a podcast too, and it can be found on Apple Podcasts, Spotify, and it's called Retire with Ryan. So if you search Retire with Ryan on any of those podcast platforms, you can find that as well. I don't have as many episodes as you, Bill, but I'm closing in.
You're doing good.
I think I've got 57 episodes, and I focus on all things retirement. And so a lot of things. We're not going to talk today about Social Security or Medicare or health insurance, or a deeper dive into these retirement plans or overall investing strategies. And that is all stuff that I talk about.
So what I'd like to say, the little bit that I know about Ryan, and it's just because we just met not too long ago, is he's not one of these financial planners that's like hooked in with these big companies. And, he's his own broker. He's his own guy. He's just a sharp guy running his own business. So he doesn't have, all these compliance reports and all these things that he has to do that a lot of financial planners have, which I just found out, which I think is awesome. So, he's got a lot of experience with all that stuff. So I like that part. All right. So
thank you.
Let's just take a couple minutes before we move on to the last question, because I want to kind of flip everything around here in a couple minutes. So my perspective on this, and you let me know, because these are people you see more than I would, because people would talk about their finances with you more than they would with me, obviously, unless I'm in there trying to buy their house. But these are the types of people you would find with these types of funds. Like they've worked for the same company for a long time, 10, 15, 20 years. They usually have those. They work for big companies, like here we have Pratt Whitney and, those types of companies. So they'll work. And this is not a steadfast thing, but when you're looking for people that might have these type of funds, Bristol Myers was another one here in Wallingford. My sister is in Bristol Myers, and she's got a big fat IRA. She was there 30 years, and she's got a huge IRA because it's just contributions. Another point on that I've noticed is that recently, and you could attest to this, but recently, like when I say recently, I think probably the last 10 years, a lot of companies started changing around pensions and the government, so if you got somebody that's like for example, the other night I was at the cigar shop, and there's a guy that works for the gas company, not the natural gas company, and he was telling us that he's vested because he's been there like 20 something years, and he's quote unquote on the old program. You know what I mean? Because when they used to hire them, they used to give.
They had a pension plan, probably.
This stuff with benefits, and he's on that, but the new guys don't get any of that. You know what I mean?
Unfortunately,
So when you're looking for people like this, one of the indicators is that they've been someplace, 15, 20 years. The company's a pretty healthy company. I mean, it's not just a plumber down the road. Although those guys, a lot of those guys do 401ks and stuff like that. So it's like reading the book. I forgot who wrote it, Henson or something like that. The 3 Minute Millionaire, the Millionaire Next Door.
Oh yeah, the Millionaire Next Door. Yeah.
He talks about the average guy. They're kind of hidden.
Somebody.
They're kind of hidden.
That's a great book. If your listeners haven't read that book, I would strongly recommend that to get an idea of how to become a millionaire. It's not what you think.
No, it's way different, right?
Yeah.
So the point is that when you're talking about these type of people, and then the last thing I want to say, and I've done other podcasts on it, but you don't go to one of these people head on and say, "Do you have an IRA? Do you want to invest with me?" So what I have found is it's best if you find some sort of a deal. Like, I just found this deal. It's a $180,000 piece of property, and I'm looking to buy it for $90,000. And I was talking to my friend the other day about using their IRA, and just tell like this story about how you're doing it. And if they're capable, they'll be like, "Well, would you consider me?" You know what I mean? So you don't want to like hit them head on, unless they're somebody you really know. Which in your case, you're saying you can't go to your mom or your dad or your brother or something like that. Anyways, but you just kind of talk around and let people know that you have this transaction and that you can use retirement funds. I never anymore use like IRA or 401ks. I just use the word retirement funds. I just did a transaction with a guy I just did a transaction with a guy. I did exactly like you're saying. There's three lenders. There's two, an IRA, my private money guy, and myself. All three of us are in the deal. It's a $300,000 house. So all three of us are in the deal, So anyways, so when you're looking for these type of folks, those are kind of some of the criteria. Longevity is a big thing. Don't think that they got the flashy cars and the flashy suits and they wear jewelry, and most millionaires aren't like that. They're usually low key. They don't want you to know they have money because they don't want to be attacked, So those are the guys with the ripped t-shirts and the holes in their shoes, but stuff like that. So when you're looking for those type of people, and like I said, when you go to approach them, you unless you know them, really well, I would approach them with, "I have this deal." And I always say to them, if you know anybody to be interested, I'm looking for retirement funds, and just leave it at that. Right? All right, good. So I'd like to end off, Ryan, with talking briefly to our listeners on the flip side of this. Okay, so we're talking about borrowing money for deals. That's
Okay.
what we've been talking about. So I want to end that segment of the podcast, and I want to talk about how you can actually have your own IRA, especially a Roth IRA, and use it for retirement fund and tax-free money. And the reason why I want to talk about
Yeah.
that is because of the type of real estate that we do here, meaning myself and my listeners. It's not hard to do a transaction and give somebody $100. Like, for example, I'm doing a transaction right now. I bought 3 multifamily houses. I didn't do it in my IRA. I wish I had at this point. But I had one 3-family. I gave the guy $100 for an option consideration deposit. Okay. Then the other 2 properties are under one mortgage. So I gave him one option, lease option on 2 properties. So I gave him $100 for that. Well, lo and behold, I've been managing these properties for 3 years. I've been making $2,000 a month. Let's just say for 2 years I made profit, and for another year I paid expenses. So I made $48,000 so far, and I've only put up $200. Okay. So and the money and the other money that I was, like I said, I got a whole year of the 3rd year. We'll just say we'll use that as maintenance, right? So and repairs. But the point is that the units paid for that. I didn't have to come out of my pocket. So lo and behold, I decide I'm going to sell the 3-family. and the 3-family is now going to spit off like $120,000.
Wow.
So here's my point, which, by the way, I'm going to take the $120,000 and I'm going to go buy the other 2 properties and do a 1031 exchange, which is a whole nother conversation, for the tax savings, because I didn't have it in an IRA, okay, or a Roth IRA. But here's the point. Imagine putting up $200,000. I'm sorry, $200 and making $200,000 in your IRA. Now, here's the thing. All that money, if it was in a Roth, it would be all tax-free. So now that I've kind of set the stage here about what I'm talking about, you run with it, and just kind of, if you could talk about that.
Yeah. I mean, first thing, would that qualify? I don't know how that would work.
Well, I would have had to use the $100 from
That's right.
the
You
IRA.
have to use the IRA to buy it first. Yeah.
Yes, and it would be in the IRA's money. I mean, it would be their money, and it would be in the IRA's name.
Yeah, Yeah, you'd just have to figure out with one of those companies how to do it. But yeah. That would be. Yeah. I mean, you hear about these Roth IRAs. I forget who it was. It's somebody who was like an early Facebook investor. Yeah. That now has like a $5 billion Roth IRA or something like that. Maybe not billion, but it's very large.
Yeah.
So the fact that that's not tax-free, I think the IRS is pretty upset about that.
There might be black cars out front watching your place. Okay.
Yeah. So yes, to clarify, so the Roth IRA was created in, I think, like 1996 or 1997 by Senator Roth, who was from Delaware, and he wanted a tax-free way for people to invest, and that's when it was created. So the initial amount you could contribute in those years was like $2,000, and it was like kind of like a joke, like what's this even going to do? And now it's up to the same limits as the IRA, now $6,000 or $7,000. But I don't know how many years ago, but at some point the Roth 401k was also created. Yep. So you could also set up a 401k plan, those same limits as we described, either through your employer or self-employed people, and put up to that $19,500 or $26,000. But
so hang on. So listen to what he just said. So if you got a job somewhere, this is what you should do. Okay, especially if you want to do real estate. You hear what he just said?
Yeah.
Set up a Roth 401k with your employer. Okay.
Yeah. So it's kind of the question, right? Do you pay tax now or you pay tax later? And if you were a great real estate investor like Bill, would you rather pay tax, to invest in the deal, or would you rather pay tax when the deal's over? And if you're going to make a lot of money, you probably, want to pay tax when you invest in the deal, because if there's a very good profit at the end, then you don't pay any tax on it. And that's essentially what the Roth IRA is. Right. And you can use it the same way. These self-directed custodians will allow you to do the same thing. You can invest in properties that you're going to, use as rental properties, or you can loan money out through them if you're going to be essentially the private banker. And you can do well by creating this tax-free income stream. The thing I always point out to people is that, not to be the wet blanket here, but it used to be that Social Security was 100% tax-free. Yes. Because we all pay Social Security tax. So why would we then pay tax on getting our own money back? But now it's taxable. And it is a possibility with the growing deficits that we have that Roth IRAs could be taxable in the future. Right. But hopefully it would be at a minimal amount, if ever. But you still probably would be ahead of the game by having money in these accounts versus a traditional IRA or 401k. But what you're giving up is the deduction, because you're not getting a deduction when the money goes in. Right. So it costs more to put that same $26,000 in. It costs whatever your tax bracket is more to get that in versus the traditional IRA. But for younger people, or if you really believe that our tax rates will be higher as a country in the future in your retirement, then by all means, you should think about putting money into these accounts. And
wait a minute, you're alluding that in 10 years from now the taxes would go down? Wait a minute. Now that's not something I know. Of course
probably
the taxes
not.
are going to go up.
But there's a way that you can actually do both, and this is what I personally do.
That's right.
I put the full amount into the 401k, and because I'm self-employed, I have a profit sharing plan. I put money into that as well. And then I make the Roth IRA contribution too. And, I will disclose that I make more than is allowed to make the Roth IRA contribution between my wife and I, right? But you're actually able to do something. This is like a side topic maybe, but it's known as a backdoor Roth IRA. So if your listeners make their AGI is higher than a joint filer, it's higher than 198,000, or a single filer higher than 125,000, you cannot contribute to a Roth IRA. You actually make too much. Right. But you can do it through a backdoor way, which is where you're able to first contribute to a non-deductible IRA and then convert it to a Roth. And if you're interested in that, I have some episodes on that, or you can just Google doing a backdoor Roth IRA contribution. But that's another great thing to do to get money in there for these deals or just for your retirement in general.
So the reason why I bring this up, Ryan, that's awesome, is because suppose we have a listener here that's probably listening or started to listen because they want to know how to get funding for their deals because they have no money. My point is that this Roth IRA is not for rich people. You just said the contribution, you can't make more than 98,000. So if you're only making 20,000 or 80,000 or 60, you qualify. Right? So again, I'm not going to dwell on this, but it is very possible, especially if you get into my contest and my 14-day email series right now, which if you go to flippinghousesforrookies.com/contest, you can get in there, and there's an email course in there on how you can do rent to own. Right? So how hard is it for us to give an option consideration deposit of $100 and make 5,000 or 10,000?
Sure.
It's not hard at all. And if you have these tools that we're talking about, whether you're self-employed or you work for an employer or whatever, you can even work for an employer and they don't have any of this stuff, and you still can get it for yourself. Right? Yeah. So the point is that I'd like to say that you should mix them up. You shouldn't do every deal in your Roth IRA so you have no cash. But if you do one deal in the Roth and one deal in your own, you get some cash, you build some retirement. There's probably a lot of listeners that are, like yourself, in the age bracket of yourself, that you're like in the middle of your life and you're making money. And if you did a real estate deal, it would be extra.
Sure.
You know what I mean? It would, because you're already making money, you're already doing what you're doing, and it would just be extra. But yet it doesn't have to infect your tax bracket and cause that to be a problem for, suppose you got somebody that's making a couple $100,000 a year and they do a real estate deal and they make 20 grand. All of a sudden their tax bracket will infect the whole $200,000.
Yeah, no, you don't want to make 50,000 on a deal and pay 30% in tax on it between the federal and the state tax.
Yeah.
Right.
on your 200 that you originally
Yes.
made plus the 50. Now
Plus
you're
the
paying on the 250.
Yeah,
It's like,
so
it's not worth it.
if you could do that in your IRA, or even better, your Roth IRA, for sure,
Right.
that's a much better way to do it. Yeah.
Right. So if you got like a good job and you're making 150, 200 a year, and you do 10, 20, 30, $50,000 on a piece of real estate, you put it in the Roth, and it kind of isolates you from the tax ramifications on your regular income, so you don't have to pay an absorbent amount of taxes because you did a real estate deal. But
Yeah.
it wasn't enough for you to quit your job, so you're like in this position, right? So
Yeah.
it's a clever way to do it, as far as I'm
Definitely.
concerned.
Yeah.
I mean, you should talk to your accountant or call Ryan up and talk to him, because that's what he does for a living is all this kind of stuff. And when he looks at your, your financial status, he can do all that. Which, by the way, we're going to start ending off here. I definitely want to emphasize. I mean, I don't know if you want to elaborate on this. He's not like some IRA expert or something like that. He definitely knows what he's talking about. No. What I meant to say is self-directed expert. That's what I meant to say.
Oh, yes.
Oh,
No,
yeah.
I know
sorry, I
quite
said
a
that
bit
wrong.
about self-directed, but yes, I'm not the expert on that.
The rest, I meant to say that the IRAs that you are in the retirement fund is where your expertise are. But if you're going to call Ryan up and say, hey, I want you to be my self-directed manager, he's not going to be that guy. He could hook you up with those people. But
I can work with people if people they haven't done a deal before and they need help. I can actually work with them through one of these custodians and guide them through the process. Because we didn't really get into this, but if you're lending money to someone, and you probably have talked about this on other episodes, but you need to protect yourself, because I've had people lend money and have their money either completely gone because they lent to someone who was either a con artist and there wasn't a deal, or they lent to somebody and they never finished the project because the person ran out of money, or they didn't, anticipate their needs, and then they had to foreclose on the property. And so there's things you have to do if you're going to be lending to protect yourself, so that you don't blow, this money that you've worked hard for.
Right. So thank you for clearing that, because I was stumbling around that. But that's the point that I was making is that if you can't do it, you have guys that can do it. That's the point that I'm trying to say.
Yeah.
That's all I'm trying to bring up. So, and I really put my foot.
I was joking, by the way.
It's like, no. Anyways, so I think the benefit, I mean, in the beginning, my rookies are going to think the biggest benefit is turning these people into private lenders and finding money. And, I did my deal hunting monthly mastery calls the first Wednesday of the month, and I did it last night. And that call is becoming interesting, because it's not just about deal finding. I have people that bring deals, and I spend half the call coaching them when I shouldn't be doing it. I should be coaching them as if they're my coaching clients, which some of them are. But one of the things that we brought up there last night was, the things are changing, the world is changing, and creative real estate is definitely more accessible, and people understand it more. It's not voodoo like it used to be. It's not Carlton Sheets trying to sell something on TV for $300 at 3:00 in the morning. There's a lot of people that are doing it. So when you're talking to people about this stuff, it's much more palatable, right? So one of the things that I brought up last night is that so many of my listeners are stuck at the beginning stages, like, how do I buy a house, or how do I get my first deal? That they've never been through the entire process before. And one of the things, a comment that I made last night in my group was, it's kind of a little bit makes me chuckle under my breath, because so many people ask me how to buy houses and how to get the money and how to do the paperwork. And not many ask me, how do you sell these houses? Because they don't know what they don't know. All their attention's on, like, I got to get my first deal, right?
Yeah.
And what we're talking about right now is on the other end of the spectrum. You know what I mean? It's like, what happens when you start buying some houses and you start making deals, because these deals are big numbers. I mean, it's not hard to make. I just closed on a deal, made $93,000, and I'm not even proud of it. You know what I mean? It's like, it sounds like a lot of money, but by the time it scatters and taxes and this and that, it's amazing how fast it goes, right? So, but somebody might think making $93,000, I make that in a year. Well, it took me a year to make that money. You know what I mean? So even though we're talking about this stuff and you may not think that you are in a position to set this stuff up, I strongly advise you talk to somebody I strongly advise you talk to Ryan personally, or speak to somebody of his capacity, because it only takes one deal. And all of a sudden you have these problems that we're talking about. It doesn't take, and sometimes you'll just stumble across it. Kind of like what I'm doing with these multifamily houses. When I signed up for these things and paid this $200, I was just going in it for the experience of having D tenants, having the problems of D tenants. I wanted to know, I've done it in the past, but Pete and I were talking about buying some big multifamilies, and I kind of wanted to get the experience, and not knowing 3 years ago that the market was going to be the way it is now. Look what happened. Right. Now all of a sudden, and some listeners are not going to get this the way I want them to get it, but it's harder to have money and protect it than not have money and try to make it. So when you sell a property, make $100 and something thousand, and that right there is almost a $30,000 tax ramification for me.
Yeah. So
it's like I'm giving away a third of my income for somebody that didn't even know I bought and sold this thing until I reported it. So when, like I said, it only takes one deal like that. Like in this particular case, I have one deal that's changed all that. And had I thought about it back then, had I paid more attention and known this was going to happen, I wish it was in my Roth, because it would have helped my Roth a lot. Because what am I? I'm going to buy other property with it, but I'm kind of babbling about this, but it's really, even if you've never done a deal and you're very serious about it, talking to somebody like Ryan is a good thing, because it gets your mindset the right way. That's all my point is, because even if because markets turn and things happen, and it takes one deal, and all of a sudden you got a chunk of dough you got to take care of. So
yeah, I've done some deals. Just not to get too far up. I flipped like 10 houses. I haven't done it in a while. I just got too busy with my financial planning practice. But I remember getting that first deal. It took a while, but once I got it, you gain a lot of knowledge, and you figure a lot out doing. And so it's really helpful.
And then you rinse and repeat it and get better and better and better.
Exactly. Yep. Yeah. You make mistakes and you look to do better and figure out how you can improve it.
Right. So let's finish off. So why don't you give us the name of your podcast and how we can contact you? Because I strongly suggest you go listen to his podcast. He's got a lot of good information. And he is, like he just said, he did 10 deals. So he is a real estate guy, which is how he ends up here, because I like that part about him. And there you go. So go ahead.
Sure. Yeah. So you can either go to morrisseywealthmanagement.com and you can listen to my podcast there, or you can on either Apple Podcast or Spotify or any podcast, just search Retire with Ryan and it'll come up.
Yeah. And Ryan is RYAN.
RYAN. Yes.
Yeah.
Yep.
Right.
Yeah.
So just go to any podcast, wherever you're listening to us now, and just hit, type in Ryan. Say it again.
Retire with Ryan.
Retire with Ryan. Good.
Yep. Yeah.
Okay. And then you'll be able to hook up with him there, and or go into the this is interesting. Mona's asking if you do anything with crypto investments.
I do not.
Okay.
No.
Good. Go ahead. You were going to say something?
No. Oh, I was just going to say, you can also type retirewithryan.com. That'll take you right to my podcast also.
Yeah. Or probably Google it. Like same thing with me.
Yeah. Or Morrissey Wealth Management. And if there's a contact form on my website, if you're interested in talking to me, and we'll reach out to schedule an introductory call just to see if you're a fit. And I'd mentioned at the beginning of the call that I am a fee-only financial planner. If you don't know what that means number one, I always work as a fiduciary for my clients, meaning looking out for their best interest. I have an obligation, a legal obligation to do that, whereas a lot of financial advisors are brokers, so they do not. And I also work with my clients on a fee basis. They pay me a fee to work with them. There's nothing, I'm not getting any kickbacks, any commissions on anything. So I'm just here to be in your corner and work for you in the best way possible and help protect and grow your money.
Much like your accountant or your lawyer. You give them their fee, and they're going to make sure they give you the right advice to the best of their knowledge, and there you go.
Yeah.
Right? And
That's
most
great.
people don't realize that financial planners are not like that. They work for companies and they get commissions on insurances and
A
all
lot of
kinds of
them.
stuff. Yeah.
Definitely, there's a movement that's been growing in the last 10 years. A lot of it, which is good. A lot of advisors have gone. I didn't start out as a fee only planner, but I moved there a number of years ago because I realized it was the best way to help my clients for now and the future.
Right.
So yeah.
Awesome. All right, cool. Ryan, thanks so much for taking the time out of your busy day and helping us out. I hope this was helpful for everyone. Again, if you can't find him, just go to flippinghousesforrookies.com, go to support, and I will put a support ticket in, and I'll make sure you get hooked up with him. And like I said, go check out his podcast and his website. And in the interim, if you're not hooked up with my contest, my Flipping Houses for Rookies contest, go to flippinghousesforrookies.com/contest. And it's worth it to be in the contest just to go get that 14-day email course that I did, which, by the way, I'm only going to do it for a little while, and then it will be a paid course for later. So Mona said, thanks for a great speaker.
Thanks, Mona. Thanks for listening.
You got A+. All
right.
All right, guys. We're going to end it off. Over and out.
Thanks, Bill. Thank you, everyone.